Hi there, and welcome to our video on buy puts and buy calls. Today, we're going to take a deep dive into what these options trading strategies are and how they work, specifically for beginners. Prepare yourself for an in-depth analysis of buying puts. Buying puts is a strategic move that can empower investors to navigate the often unpredictable stock market with confidence and potentially profit from declining stock prices. When you purchase puts, you acquire the right, but not the obligation, to sell a specific stock at a predetermined price, known as the strike price, within a certain time frame. This means that if you have a strong belief or anticipation that a particular stock's value will decrease in the future, buying puts allows you to secure the option to sell it at a higher price than its potential future market value. The beauty of buying puts lies in its ability to act as a protective shield against potential market downturns. By owning puts, investors gain the advantage of having a form of insurance in their portfolio, safeguarding them against potential losses resulting from a declining stock market. This defensive strategy can be particularly valuable during times of economic uncertainty or when specific industries or companies face potential challenges. Example of buying puts. Let's say you've been closely following the stock market and have identified a company whose stock you believe is overvalued and due for a decline. You decide to employ a strategy called buying puts to potentially profit from this anticipated price drop. To execute this strategy, you contact your broker and purchase put options for the chosen stock. Let's assume the current market price for the stock is $100 per share, and you select a strike price of $90 with an expiration date 3 months from now. By buying these puts, you acquire the right to sell the stock at $90 per share within the next 3 months. Now let's consider two possible scenarios. 1. The stock's price declines. As you anticipated, negative news about the company emerges, causing a general decline in the stock's value. The market price of the stock drops to $80 per share. In this case, you hold the option to sell the stock at $90 per share, even though the market value is lower. This allows you to capture a profit of $10 per share. So if you purchased multiple put contracts, each representing 100 shares, your potential profit could be substantial. 2. The stock's price remains stable or increases. In this scenario, your prediction of a stock price decline didn't materialize. The market price of the stock stays at $100 per share, or even rises above it. Since you have the right but not the obligation to sell the stock, you can choose not to exercise the put option. However, the premium paid for the puts is considered the cost of participating in this strategy and would be the loss in this scenario. In summary, buying puts is a strategic move that allows investors to potentially profit from declining stock prices. By purchasing put options, investors gain the right to sell a stock at a predetermined price within a specified time frame. If the stock's price declines below the strike price, investors can exercise their right to sell the stock and potentially earn a profit. However, if the stock's price remains stable or increases, the premium paid for the put options represents the potential loss. Thus, this strategy requires thorough analysis, risk management, and a well-informed assessment of the stock's future price movement. Let's dive deep into a detailed understanding of buy calls. Buying calls is an exhilarating and potentially rewarding strategy that allows investors to actively participate in the upward momentum of a stock's price. When you buy calls, you gain the right, but not the obligation, to purchase a specific stock at a predetermined price, known as the strike price, within a specific time frame. This strategy becomes particularly appealing when you have a strong belief or expectation that the price of a particular stock will rise in the future. It's important to note that the potential profit from buying calls is not limited to the difference between the market price and the strike price. The value of the call option itself can increase as the stock's price rises, leading to a higher premium. If you decide to sell the call options before their expiration, you can potentially realize a profit from the increase in their value, even if the stock price hasn't reached the strike price. While buying calls offers significant profit potential, it's crucial to consider a few factors. Accurately predicting stock price movements can be challenging, and the premium paid for the call options represents the potential loss if the anticipated price increase doesn't occur. Additionally, the time frame of the options contract should align with your investment objectives, as options have expiration dates that determine the validity of the rights conferred by the call options. Example: buy calls. Let's dive into an example to illustrate how buying calls works. Imagine you've been diligently researching and analyzing a company's fundamentals, market trends, and news. Based on your analysis, you have a strong conviction that the company's stock is poised for significant growth. You decide to capitalize on this opportunity by contacting your broker and purchasing call options for the chosen stock. For instance, suppose the stock is currently trading at $50 per share, and you select a strike price of $55 with an expiration date 3 months from now. By buying these call options, you secure the right to purchase the stock at the strike price within the next 3 months, regardless of any potential increase in the stock's market value. Now, let's explore 2 potential scenarios that can unfold after you purchase the calls. 1. The stock's price increases. In this scenario, your prediction proves correct, and the stock experiences a substantial upward movement. Let's say the market price of the stock rises to $70 per share within the specified time frame. Since you hold the call option, you have the right to purchase the stock at the lower strike price of $55. This allows you to capture a profit of $15 per share. If you have purchased multiple call contracts, each representing 100 shares, your potential profit could be substantial. 2. The stock's price remains stable or declines. In this case, the stock's price fails to meet your anticipated upward trajectory. It either remains at the same level or even decreases during the specified time frame. In such situations, you have the option, but not the obligation, to purchase the stock at the strike price. However, if the stock price remains below the strike price, it would be more advantageous to buy the stock directly from the market at a lower price, rather than exercising the call option. In summary, buying calls is an exciting and potentially lucrative strategy that enables investors to actively participate in the upward momentum of a stock's price. By purchasing call options, investors gain the right to purchase a stock at a predetermined price within a specified time frame. If the stock's price exceeds the strike price, investors can exercise their right to buy the stock and potentially earn a profit. However, if the stock's price remains stable or declines, the premium paid for the call options represents the potential loss. Therefore, careful analysis, risk management, and an understanding of market dynamics are crucial when employing this strategy. In conclusion, buying puts and buying calls are 2 powerful strategies that offer investors exciting opportunities in the stock market. With buying puts, investors can protect their portfolios and potentially profit from declining stock prices. It's like having a shield against market downturns. On the other hand, buying calls allows investors to participate in the upward momentum of a stock's price, potentially earning handsome profits when they believe a stock will rise. It's like capturing the excitement of market growth and turning it into financial success. We hope you found this video informative, and we encourage you to like, subscribe, and leave a comment below with any questions or feedback. Thank you for watching, and we look forward to bringing you more informative content in the future. And we'll see you in the next video.